Welcome, my name is Vicenteluz with Forex Trading Institute. Please take a couple of minutes and go over the following risk disclosure. Lesson 14, Analyzing the Market. One philosophy is not best expressed in words, it is expressed in the choices we make. Choose to let the market meet your criteria before you trade. And in this lesson, we're going to learn how to analyze the market and put everything together when we trade. Everything that we've learned, we're going to put it together and apply it to the market. Now, traders are trying to find comfort in the number they trade. They want to be right. Every trader is doing nothing more than trading numbers, searching for a way to make money. Using trading systems and indicators combined with education can participate in your success. Take the knowledge from your technical education and use it with your indicators created on your computer. One of the strongest indicators is the trend line. Now, there's two types of trading environment during each trading session. There are 3 trading sessions each day. We have the Asian session, we have the European session, and then we get the United States session, or the America session. And each session will have a trading day or a trending day. And it's critical that you understand which environment you're in before you trade. This is like when you're going to go out in the morning from your house. You want to know if it's raining, if it's snowing, if it's hot, if it's cold, to depend on what clothing you're going to put on. The same thing is in the market. We're going to learn if it's a trading day, we're going to apply certain strategies. If it's a trending day, we're going to apply other strategies. Now, a trading session, there's no fundamental announcements. Trading will be slow. The market during the session will create a trading range between 60 through 90 pips. The trading session may have a small breakout. However, prices usually return at the end of the session back or near of the opening price of the session. And the market will create an upper bell curve, lower bell curve, or just a sideways movement during the session. And we can see it here. Look how the market here, we had the Asian trading session day. We had a lower bell curve. It went 30 pips up and then back down. Then the European trading session, upper bell curve. Okay, 60 pips up and 30 pips down. Then we have the U.S. trading session here, where we saw the lower bell curve. Okay, 60 pips up and 60 pips back down. And this process continues to repeat itself. Now, in a trading day session, there's fundamental announcement. Trading will be aggressive. The market movement in each session will create trading ranges between 120 and 300 pips every day. The market will create an upward or downward trend, and the trading session prices will not return, the majority of the time will not return to the open price of the session. And we could see it here. The market flew up here in the U.S. with fundamental announcements, creating a strong trend up. And as you can see, the market did not break down. Then it went sideways for a while. And then the next day, we had a big 150 pips back down. And look how the market produced a very nice crown. Now, when we set up our trade, you want to place 4 charts of the same currency on your screen. Example, we have the euro. You're going to watch the daily chart, the 4-hour chart, the 60-minute chart, and also the 10 or 15-minute charts. And all the charts will be of the same currency. I'm going to show you how to apply this in the live market. And you can see an example here. We open up a chart. We open up a daily, 4-hour, 60, and 10 or 15-minute chart. Now, when we set up a trade, the first thing we want to do is draw all our trend lines. Okay, the daily and the 4-hour charts will be where the majority of the trends will be found. And the 60 and 50-minute charts will respond to the trend lines and convergence from the larger time frames. And you will get your direction for the day from your larger time frames, and then you're going to trade off the smaller time frames. For example, here, look how we're looking on a daily, and it's a downtrend, and we have also on our inner and outer trend line, it's pointing down. And in the 4-hour chart, we can see we're also on the downtrend. Okay, and on the 60-minute chart, we could see we're also on a downtrend. Now, the daily move is projecting a downward trend, so we're looking at are all lining up. And I'm going to show you this also when we head to the live market. Now, when we use indicators, you want to trade your indicators in the direction of the larger time frame. You want to find your ABCDs. Okay, on your larger time frame, and also trade it on the smaller time frame. You can use your trend lines and crown formations to help visually spot reversals, and you always want to fill out that trader's checklist before you trade, and do not trade any signal if it does not meet your equity management. Now, setting up your trades for long-term trading or short-term trading, you want to use charts to determine the direction on the 4-hour and trade in positions of perhaps maybe 1 to 4 weeks. Obviously, if you're going to be position trading, you look at larger time frames. You could use 4-hour charts to determine the direction on 60-minute charts and trade positions on perhaps 1 to 4 days. Or you can use 60-minute charts to determine the direction on the 10-minute chart and trade positions on 1 or 24 hours. I usually use a 4 time frame rule. What does that mean? If I'm going to use the 60-minute to determine the trend, 4 time frames less would be a 15-minute chart to enter my trade. If I'm going to use a 4-hour chart to determine the direction, then a 1-hour chart to enter the trade. Usually, if I use a daily chart to look at the direction, then I enter on a 4-hour chart. Now, in all cases, find the direction on the trends on the larger time frame. Try to figure out on a larger time frame where the ABCDs are, and equate that into a smaller time frame. That will help you project the current move. For example, if the larger time frame, the market's moving towards the D extension, the daily move will probably be up on a smaller time frame. Now, if it is retracing in a downtrend on a larger time frame, the daily move will probably be up. Now, for example, here's where you could see it. When the market moves towards the trend lines on a larger time frame and hits, you will probably see a reversal on a smaller time frame. So if you're seeing the markets retracing back on a 4-hour or a daily, and you see it's about to hit the trend, your first signal is going to be a crown or a break in the trend line in a 1-hour or 15-minute chart. And when you're seeing this in the 4-hour, you got to expect a reversal. You got to expect a crown on a 1-hour or 60-minute chart. And you can see it here. The market was heading up. It was doing this uptrend, and then it broke and it headed down. Now, setting up your trades, find the direction of the trends on the larger time frames. Enter the market using the smaller time frames. So you could have seen it here. The market did the A, B, C, and you're waiting for the C to go to D. Then you got to wait for a trend line break, okay, or the crown, and you could have seen the new A, the new B, the new C to go in the direction of the trend on a smaller time frame. Now, very important for you to study. If you don't review this, remember the reality of trading. Only 10% of the traders succeed, and 90% of most novice traders fail. And the reason they don't is because they don't take the time to properly educate themselves. Obviously, you guys are taking the time, and you got to practice this and apply this and put it all together. You want to be in this 10%, not in these 90%. This is a very rewarding career if you really know how to apply it and take the time to study this market. Okay, now let's go to the market. I'm going to show you how you apply this analysis. Now let's open up a chart. Okay, and I like opening up, you could do 4. I like, let me put here the dollar yen. Okay. Now, let me show you how to apply this. I like putting a minimum of 3 charts. I like trading off the daily. Very rarely do I go down to the 60, but that all depends on your trading style. Okay. Now, I like going to a daily Okay, open up a daily. I like opening up a 60-minute chart and a 240 chart. Now, how do I use this? Okay, the first thing you want to go is to the daily and determine the direction of the trend. So let's start doing our ABCDs. Okay, and as we can see here, I'm going to show you how to apply and put all this together on your analysis. Okay, so we had the A, and now I'm going to show you here the B. So the first thing you want to do is go back and see where did the trend start. So here's where it started trending down. And the same thing would have been when the trending up, but we had a trend line break, so now we're doing a downtrend. So when you see here, you start with your A, the point where the fall began. So you go, here's the A, here's the B, okay, and I like usually putting a boundary between the A-B boundary, and then I'll pull my Fibonacci from A to B, okay, and I'm looking for the C and the D move. Now, I see that the market went back to the 618, and then it went to its 1618. So I could project my extension to the 1618, and look how the market went exactly to the 1618, extended, and then pulled back. Okay, so now I could draw my trend line here. Okay, now when I do this, I go, okay, now I have an A, I got a B, and the market retraced back to C, and I'm looking for another D extension. So I could erase here, I go A, and here I had the B, okay, and now the market was going from C to D. So now I could hit, okay, let's see where the next extension. Look how it pulled back past support, future resistance. So the market again hit 50%, and now it's going to rally all the way down to the 1618. Okay, so that was the next rally. So now I could replace again. Remember the A's. Okay, this becomes, sorry, I don't want to move that trend line. This becomes the new A. This becomes the new B. Okay, the market pulled back to C, and now it's finding a new D. So I could pull this trend here and say, okay, this is the new A, this is the new B, okay, and see where did it pull back. Look how it did a pullback all the way to 786. So now the new extension is the 127%. That's a new projection. And look how the market went. And you're going to be surprised how effective this Fibonacci tool is. Look how it went exactly to the 27%. So now I could draw my other trend line. Okay, and now I was finding a new ABCD. So now I could see this, and I move this A, this B, this C, and I'm trying to find a new D. And here's where we are right now. You see how I work backwards, and I go to the present. So I go A, sorry, let me pull back here. I like making a line at A and a line here at B, so I know my AB boundary, and I'll pull from A to B, and look how it went to the 50% at a past support, future resistance. Look how this was a past support, future resistance. It hit here, and now it's on its way. It pulled the 50% means the D extension is on its way to this 1618. So when we go to a daily chart, obviously for the day we're seeing, and we had a support here area, and we broke that support. Now that means this wants to start running from C to D. So we should only be looking, and we could clearly see we're below the inner trend line and the outer trend line. This is the inner and this is the outer, and we're in a downtrend. So we're only looking for shorting signals, since we're going from C to D in a daily chart. If we were going to B and C in a daily, then we'd probably be looking for buy signals. But now we're looking for selling signals. So when I look at this, I go down to my 240, and in the 240, I'm going to see exactly the same idea. Look how we were on the previous trend. We were doing an A. Sorry, let me change this font here. We were doing an A. Okay, and we did a B. Okay, and the market did a C, and then here it did its D extension, and I had a trend line going from A to C, and it broke that trend line, and now we're heading on a downtrend. So okay, so now we're also bearish on the 240, giving us the direction. So we're bearish on the 60, we're bearish on the 240, and look how we could see a support here, and we had a support that we broke here. So definitely the next floor, for example, it's 88.41. So we got still room to go on the 60-minute chart, on the 240 chart. So we go down to the 60, and in the 60, all we're seeing is that downtrend. Look how we had a previous uptrend, which was broken, and then we started doing A, B, C, D, bearish A, B, C, D. So I go down here and see this, and I say, okay, this was my A. Okay, this was my B. This is for the first A-B boundary we had. Okay, and I'm looking for a C to go to down to its D extension. So I could pull my Fibonacci tool from A to B, and look how the market extended here. Okay, and I could draw my trend line here. Okay, and we're in a downtrend. Now we could replace this and say we want to move all the way to the present. So we say, okay, this is the new A. Bring down my line here. This was the new B. Okay, and the market went to a C, and then it did its new D extension. Okay, and I could continue moving and say, okay, now this is the new A. This is the new B. And we're looking to go from C down to the D extension. So if I pull my fib tool here from this A to this B, I could see we're getting very close, and we hit that extension. So now we have a new A. Okay, and I could have drawn this prior trend line here for the inner one, which is very close to the outer one. I could say now this is the new A, this is the big B, and we're looking for a C. So I could move, let me just draw again, C here. We're looking for this C to make another run to D. So if I was trading this right now, I'm looking for a short signal. Now I wouldn't, because this is probably going to retrace back a little before it makes its downward move. So if I'm looking at this A to this B, I want to say, okay, this market pull back, give me a formation here, especially because now I have a resistance point here. And here's where I could also start adding all my other indicators. For example, I could, I like using my pivot points. Okay, and I could see that the daily pivot point, okay, it was all the way up here. Now, in a couple hours, a new pivot point is going to enter, and we just closed. We're about to close. It's about almost 4 p.m. Eastern, so the U.S. market's open. I would want to wait for the Asian market to open. Most likely it's going to retrace back, give me another signal here. If it gives me a signal here, here's where I'll trade it, and here's where you have to have patience, and you got to do what the market wants you to do, what the market's telling you to do, not what you want to do. Okay, so if the market does not come back here and doesn't give me a signal, I won't enter this trade. Okay, so as you can see, we want to always trade in the direction of the trend, using obviously our larger time frames to determine that direction. Okay, so this is the way you analyze the market. Obviously, putting all the additional tools, how you use the different time frames to things. You always want to use the larger time frames to make trades on the smaller time. I like using the daily and 240. That's my preference to execute trades on that 60-minute time frame. Okay, my name is Vicenteluz with Forex Trading Institute, and I'll see you at the next lesson.